We're in the midst of a reverse stock market crash. Yes, folks, that's the new term used for coining the bull market phase that we've entered over the past few weeks, as the NASDAQ is on track to hit a fresh new all-time high. Yes, folks, following a string of impressive earnings reports for the third quarter, market expectations have improved significantly alongside sentiment, as people are realizing we are near the bottom of the interest rate cycle hike, as well as the valuations of many of these most beaten down companies. Markets have nearly completely erased all of the drawdown we've seen since the start of 2022, when investors were panicking as the Fed was raising interest rates and valuations were collapsing alongside profits. And because of something called recency bias, many investors on Wall Street simply can't explain why this is happening. And in this video, I'm going to do their due diligence for them. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, folks, let's first understand what has taken place since September to result in such a stark shift in broad market sentiment. And as it turns out, to answer that question, you don't need to look any further than the VIX Volatility Index, which has now erased all of the gains it made since the start of the pandemic more than 3 years ago. As you can see, folks, this index tracks the options volatility of the S&P 500 and is an essential measure of fear in the market. If people are hedging against their bets on the long side, they're going to bet on put options on the S&P 500, which is going to spike this particular index as the implied volatility increases. And as you can see, folks, clearly that sentiment of fear is starting to wane out significantly. Where many people say markets take their stair steps up and the elevator down, we're seeing the exact opposite play out, where the correction we saw in the S&P 500 since the start of August has been faded away rapidly in just a matter of a few weeks. And as it turns out, for those that look at historical data, this should not have been that much of a surprise. And why is that the case? Well, because, folks, as it turns out, bear markets don't last forever, and stocks are always forward-looking. At this point, we're looking at earnings estimates for the second and third quarter of 2024 and where companies are going to be then instead of where they are right now, which is why the NASDAQ and the S&P 500 are basically break even since January of 2022, particularly because the companies in those indices are some of the best, most profitable, highest margin, and best laid out companies basically on planet Earth. And for me, like I've said countless times over the past few months, the opportunity to invest now lies in the lagging indices, particularly around high growth and small cap stocks, as clearly seen by the red line in the Russell 2000. Forget macroeconomics, folks. At this point, markets are driven by the technicals and simple sentiment shift. Yes, macro has an immediate impact on the conversion of a bull market to a bear market, but once the bear market has surpassed a certain time frame, historically, they tend to diverge significantly. And instead, we saw this textbook accumulation pattern take place in those bigger indices, which lasted for well over a couple of months, and now we're starting to see that breakout phase from point A to point B. And this, folks, is actually a very similar case for ticker symbol IWM. Now, why exactly does this ticker matter so much? Well, because it tracks some of the smaller companies in the market, which is something most retail investors have much more exposure to because of their higher growth as well as higher opportunity for profitability. And as you can see, this index has not recovered at all following what the NASDAQ or the S&P have been doing. And although it's been a painful few rides over the past 1 to 2 years, chances are we are in that accumulation phase and the turn towards the next breakout phase is just around the corner. And this, folks, is where the concept of a reverse stock market crash is coming into play. Because although these recessionary data are showing us that many companies are struggling and the number of bankruptcies we're seeing is not really the best sign, this is indeed exactly how the bottom of bear markets are formed. Many people still believe a market crash is ahead of us. And as we all know, those same many people are the ones that basically make no money investing in single stocks over the long term, which is exactly why taking their advice is the absolute wrong thing. Large caps like your Microsoft, Amazon, Alphabets, and Googles have already bottomed, and they have put the bear market in the rearview mirror. The thing that now is going to change sentiment faster than ever before in the retail space is going to be when the smaller companies start skyrocketing 20, 30, 50% on a year-to-date basis. And as you can see, right now that is simply not happening, and something that is potentially brewing for big break. Yes, it's true that small cap companies with a market cap under $10 billion are inherently much riskier than large caps, which is why they are disappropriately affected during times of recession. But at a time when bigger companies are outperforming, cash has a really good history on a seasonal basis of flowing back into the smaller ones that may be following in a similar sector, even though their prices have depressed significantly. Yes, you have to be aware of the fact that small caps in the long term always underperform the large caps because the large caps provide much better shareholder returns through buybacks as well as dividends, which make them simply much more attractive. But in the short term, a lot of these small caps do have the opportunity to convert themselves into large caps and get included into your mid cap, S&P 500, and NASDAQ indices, which is why a chart like this on the screen right now is sometimes misleading to look at. And the most interesting thing is that volatility in something like the Russell 2000 Small Cap Index has skyrocketed to levels we have really never seen since the dot-com bubble of 2002. Just a few days ago, the index had one of its best days with a gain of more than 5.5%, leading many to believe that a short squeeze is at play for not only the index, but particularly some of the companies that it encompasses. This, paired with the fact that the S&P 500's price-to-earnings multiple right now is still below its 20-year historic average, in the context of all the innovation with artificial intelligence and software that we're seeing, makes me really optimistic that this reverse stock market crash is indeed the next bull market. Yes, you're going to have to do your research and pick the right companies, and not every single stock is going to outperform with the index. But as usual, let me know your thoughts on this situation down in the comment section below. Thanks a lot for watching, folks, and I'll catch you guys in the next one. Take care.